So now we know how to calculate the tax on a gain and how do we need to consider the annual exemption, any losses brought forward. Let's sort of go back a step and say, well, where does this gain come from? And as it says here, we need to calculate the gain for each individual asset. So if I sell 5 different things, I need to do this for each one. So we need to make sure that we learn this pro forma. Right, in order to do that calculation. And it's unlikely in your exam you're going to have to do all of these things, but obviously any of them that you come up, you need to know, where they go in the computation. So in simple terms, you're saying, what did I sell it for and how much did it cost me? But we do need to know what sort of things we can deduct as a cost. So it starts at the top of the formula where we take the proceeds. Now the proceeds may not always exist if we've not sold it, if it's been a gift. We'll look at that in more detail later on. Let's assume at the moment we get some money for this asset. And basically you're allowed to deduct any costs that you incurred to sell the asset, such as paying any legal fees, maybe you had to pay an estate agent if it was a property, and any expenditure that you incurred to buy the asset. So if it were a house, what did the house cost? What did the warehouse cost? And then any other costs that you incurred at the purchase date. So did you have to pay any legal fees? Was you required to pay an auctioneer fee? Did you have to pay any stamp duty? So in simple terms, what did I sell it for? What cost did I incur to buy and sell it? And then the final thing you're allowed to deduct is enhancement expenditure. And you've come across this in your financial accounting and also in the first booklet that we looked at. Enhancement expenditure is where you have an improvement. So think of it as a capital cost. It's when you're adding something to the asset. So let's say I bought a house and I decided to extend the house. Let's buy, put a garage on it or a conservatory or something. Then that will be classed as enhancement. So it's not repairs and maintenance. Right? It's not like you're decorating the house or painting the wall or something like that. It's an actual enhancement. So for each asset, we need to work this out and find out the difference between the proceeds and the cost, and you may end up with a gain or you may end up with a loss. Now, what you would do with each of those gains and losses is do what we did on the previous pages, where you're going to sort them out into residential gains and other gains. So all your houses will go in this column and all your other assets will go here. If you've got some assets where you make a profit and some you make a loss, you will net off the current year gains and losses. All right, so this is not optional. You must net off everything that is for your current year. Remember, any deductions you want to take from the residential over the other gains, and that's because residential will be subject to a higher tax rate than your others. Remember, the sort of things you can deduct are losses brought forward and annual exemptions. But what you are allowed to do is you are allowed to protect the annual exemption allowance. All right, so you don't have to use those losses brought forward if there is no benefit from using them. So if you've already going to eliminate the gain with the annual exemption, you would always use that in priority to the losses brought forward, because if you don't use those, you can carry them forward and there's no limit to how long that can go on for. Now there's some more details on your notes on how this works, but what I'm going to write here is that we're going to refer to this in example 2.3 over the page, because actually it's a lot easier to understand how you protect this annual exemption by doing a question. So you can read through these notes for yourself. I haven't really got anything I can add to it, but what I do want to do is I want to go through this example 12.3. So here we've got 3 different scenarios. We've got Angie, Bertie and Carly, and for each one we've got to work out what the capital gains tax assessment is going to be. So we've got to look at the 3 scenarios and decide what we want to do. So if we take Angie, her current year gains are 8 and her current year losses are 1,300. So we need to deal with those first. All right, we always net off the current year gains with the current year losses. Okay, so 8,000 minus 1,300. So the net gain for the year is 6,700. Now, in order to reduce that gain, she can use any losses brought forward, and she can use her annual exemption. So remember what we said on the previous page, that we always aim to protect that annual exemption. So we want to use that in priority to the losses that might be brought forward. And that's exactly what we're going to do for Angie, because the annual exemption is 12,000 and her net gain is only 6,700. So the most that she can actually use is that amount. So the rest of the annual exemption is in fact going to get wasted, and the amount that's taxable is 0. So her losses that are brought forward, which is 2,000, are just going to be carried forward. So she's not using any of those, and she's going to carry that loss forward to next year. So if I deducted that 2,000 there, all it would mean is I'd waste more of the annual exemption. The result would still be the same. So what's the point of doing that if I'm allowed to protect that? All right, so hopefully that makes sense. Let's look at the next example then. So Bertie has got a current year gain of 13.5, and he's got current year losses of 1,500 and a loss brought forward of 3,000. So if we net them off again for Bertie, so 13.5 is his gain, 1,500 is his loss, giving him a net gain of 12,000. Now he can wipe out all of that gain using his annual exemption. So he can use the full exemption, and therefore there is no point using any brought forward. So that brought forward loss there of 3,000 will be carried forward and used next year. And finally, for the third question, we've got Carly has a current year gain of 18,200, current year losses of 1,200, and a loss brought forward of 4,000. So Carly, we will have the gain of 18,200, net off the loss to get 17. Take off the annual exemption first to see where we are. Well, we've got a taxable gain of 17, the exemption's only 12, so I've still got 5,000 to tax. So if we look at what we've got to use of the losses brought forward, well, we've only got 4, so I can't get the taxable amount down to 0, but what I can do is I can reduce it to 1,000. So in that case, I would use the losses, and that means I've got nothing to carry forward. So the key thing with this situation is that you cannot do anything about the losses for the current year. They have to be netted off against the gain. So I couldn't ignore that 1,300. I've got to net that off against the gain because it's happened this year. But when I've got brought forward losses, that's where I've got the choice, where it is better to use the annual exemption first, and then only if something's still taxable to use those losses brought forward. So if you're happy with that example, what I suggest you do is you go back and have a little read through these notes, all right, just to make sure that you fully understand it. But that deals with how you can reduce your gains using the losses annual exemption in order to benefit the taxpayer in the most efficient manner.